The silent business partner in your retirement account already owns somewhere between 20 and 30% of everything you've ever saved. You didn't sign that agreement consciously. You didn't negotiate the terms. And the moment you turn 75, they get to decide how much gets pulled out, whether you need the money or not. But here's the layer nobody shows you from the title alone. There is a 15-year window before that clock runs out, where you can buy them out at a discount. And for someone with $2 million in a traditional IRA right now, executing this correctly could legally keep $300,000 to $400,000 out of the IRS's hands. That is not a rounding error. That's a beach house down payment. That's a decade of travel. That's the difference between the retirement you imagined and the one the tax code designs for you by default. Let's talk about how to actually do it. Most retirement planning conversations start with the wrong question. People sit down, open a spreadsheet, and ask, how much can I spend? That sounds like the right question. It is not the right question. The right question, the one that almost nobody asks first, is how much will the IRS force out of my accounts whether I want it or not, and at what rate will they tax it? Because if you don't know that number, you're not building a retirement plan. You're building a guessing game with a 30-year fuse attached to it. Here is what I'm going to show you today. A 4-step system, I call it the buyout plan, that turns what most people experience as an inevitable required minimum distribution catastrophe into a completely manageable non-event. One couple, one $2 million IRA, 15 years. I'm going to walk through the whole architecture, when to pull, how much, from which account, in what order, and why the sequencing matters as much as the dollar amount. By the end of this, you'll be able to look at your own situation and see exactly where the gaps are. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link is in the description. Here's the metaphor I want you to hold on to for this entire video, because it's going to come back as both the explanation and the punchline. Think of your traditional IRA as a business you co-own with a silent partner. That partner is the IRS. They don't show up to meetings, they don't do any of the work, they never answer emails. But they have a contractual right baked into the deal you made with every pre-tax contribution to somewhere between 22 and 37% of every dollar that ever comes out of that account. You got the deduction up front, they get paid on the way out. Now here's the part of the partnership agreement most people never read. When you hit age 75, the silent partner gets to set the withdrawal schedule. Not you, them. They look at your balance, they look at an actuarial table, and they hand you a number. That number is your required minimum distribution. Pull it out, pay taxes on it, every single year. The fact that you didn't need the money, that you were planning to leave it to your kids, that pulling it out bumps you into a higher bracket, the silent partner does not care. They waited patiently for decades. Now they want their percentage. The buyout plan is exactly what it sounds like. You spend the 15 years before that forced withdrawal moment buying the silent partner out on your terms, at a rate you choose rather than theirs. Every dollar you move from the traditional IRA to a Roth is a dollar where their ownership stake drops to zero, permanently. No RMDs on Roth accounts, no mandatory distributions, no forced income events. The money grows tax-free and comes out tax-free. Here is the line I want you to remember all the way through this video. You cannot fire the silent partner, but you can buy them out. In a few minutes, I'm going to show you how Social Security timing changes the size of this buyout window in ways that most financial media completely ignores. But first, let's talk about what actually happens when you do nothing. Because the math is more uncomfortable than people expect, and I want you to feel the weight of it before we talk about the fix. You think the problem is that required minimum distributions exist. The actual problem is how enormous they become if you let a traditional IRA run uninterrupted for 15 years. Here's the scenario. You are 60 years old. You have $2 million in a traditional IRA. You retire. You have some money in a taxable brokerage account for living expenses. You figure you'll let the IRA keep compounding until you actually need it, which seems completely sensible. At a modest 5% annual growth rate, and that is genuinely modest, The S&P 500 has averaged over 10% annualized for the past 30 years. That $2 million IRA becomes roughly $4,160,000 by the time you turn 75. 15 years, 5%. Do the math yourself if you want to check it. The number is real. $4 million sounds like a success story. Then you open the IRS's Uniform Lifetime Table. At age 75, the distribution period factor is 24.6. You divide your balance by that number. 4,160,000 divided by 24.6 is roughly $169,000. That is your minimum required distribution for year one. That money comes out, it is taxed as ordinary income. You do not get a choice about whether it comes out. The only choice you have is whether you spend it or reinvest it in a taxable account where it will be taxed again. Now add Social Security. Let's say $40,000 a year. Add dividends from a taxable brokerage. Add maybe a small pension. Your combined income is suddenly north of $225,000. You have crossed into the 24% federal bracket, and you are knocking on the door of 32 for a couple who spent their entire working career earning a combined $120,000 a year. The irony is so thick, you could build furniture out of it. You saved responsibly. You maximized contributions. You let it compound. And the reward is a forced income event in your mid-70s that taxes you at a higher effective rate than you ever paid during your working years. The silent partner waited, and now they want their 32 cents on every dollar. Here is what genuinely frustrates me about this situation. The people who end up here are not financially reckless. They are not bad at math. They followed standard advice: maximize contributions, minimize withdrawals, let compound interest do the work. The problem is that advice was written for the accumulation phase. The decumulation phase has a completely different playbook, and most people find out that second playbook exists only after the window to use it has already shut. I read about a guy once, a retired engineer from Indiana, call him Frank, who spent 35 years optimizing manufacturing systems: cycle time, material yield, defect rates. His entire professional identity was built around finding inefficiencies before they became problems. He retired at 62 and did something most retirees never do. He went and read the IRS publication on required minimum distributions. Not because he enjoys tax law, because it was a system he had to understand. He called it the most expensive document most Americans never read. He spent the next 12 years doing Roth conversions, methodically, like a production schedule. When his first RMD arrived at age 75, it was $46,000. His neighbor, same age, similar account balance, 15 years prior, did nothing. Got a first RMD of $171,000. Same starting point. 13 years of different decisions. Frank took his wife to Italy. His neighbor took a large tax bill. This is where it gets really interesting. In a few minutes, I'll show you the IRMAA Landmine that sits inside the conversion strategy and can wipe out thousands of dollars of savings if you don't see it coming. But first, let's talk about the conversion window itself, because it is the core of the entire buyout plan, and most people use it either too conservatively or not at all. From age 60 to age 75, before the silent partner starts calling mandatory meetings, you have something you have almost never had in your entire financial life: total control over your taxable income. During your working years, your employer controlled your income. During your RMD years, the IRS sets your minimum. But this 15-year window, that belongs to you. And what you do with it determines the tax story for the rest of your retirement. Let me walk you through it with actual numbers, because the framework only makes sense when you see the dollars. Meet Dave and Linda. They're 60, $2 million in a traditional IRA. They've also got a taxable brokerage account with enough in it to cover their living expenses without touching the IRA. That second detail, the brokerage account as a spending vehicle, is a hidden multiplier in this strategy that I want to flag before we move on. In 2026, the federal tax brackets for married filing jointly are roughly as follows. The 12% bracket tops out around $94,000 in taxable income. The 22% bracket runs up to about $210,000. The 24% bracket extends to around $400,000. The 32% bracket kicks in above that. These numbers adjust slightly for inflation each year, but the architecture stays the same. Right now, Dave and Linda have very low taxable income, no salary. Social Security, not yet claimed. Some dividends from the brokerage, maybe $30,000 to $45,000 of total taxable income, which means the vast majority of those lower tax brackets is completely empty. They can convert traditional IRA dollars to Roth every single year during this window at whatever rate fills those empty brackets without crossing into the higher ones. If their other income is $40,000 and they want to stay inside the 22% bracket, they can convert up to about $170,000 this year. They pay federal tax on that conversion at 22%, roughly $37,000. And those $170,000 are now in the Roth, growing permanently outside the silent partner's jurisdiction. By the way, hit subscribe if you like this content. Otherwise, the YouTube algorithm may never show you my videos again. That is genuinely how the platform works. It needs a signal. Let's run the comparison. If Dave and Linda convert $150,000 per year for 10 years, that is $1.5 million moved to Roth. They will have paid approximately $330,000 in federal taxes over that period. That sounds painful. Here's the comparison. If those same dollars had stayed in the traditional IRA and come out via RMDs at 32%, the tax bill on the same $1.5 million would be $480,000. The conversion strategy costs $330,000. The do nothing strategy costs $480,000 on the exact same dollars. That is $150,000 saved by moving the same money at a different time at a different rate. Not by finding a loophole, not by using an exotic financial product, by reading the tax code and executing a plan. You cannot fire the silent partner, but you can buy them out at a discount. There is one more dimension to this conversion window that I have not mentioned yet, and it is the reason why the taxable brokerage account is so valuable as a companion to this strategy. If Dave and Linda are living exclusively off IRA withdrawals, then every dollar they pull for living expenses eats into the bracket space they could otherwise use for conversions. They are competing with themselves, but because they have the taxable brokerage account, they can live off that money paying taxes only on dividends and capital gains, which are typically taxed at 0 to 15%, while their entire bracket space goes toward Roth conversions. The coordination of those two accounts is not a side detail. It is what makes the math reach its maximum efficiency. If you do not have a taxable brokerage account, you can still run this strategy. You just factor your living expenses into the conversion calculation first, then convert whatever bracket space remains. The math still works. The window is just slightly narrower each year. Now, Social Security. And this is the part that almost nobody talks about when they explain Roth conversions. The standard Social Security conversation goes like this. Claim at 62 and get a smaller check for longer. Claim at 70 and get a bigger check starting later. Break even somewhere around 82. It's essentially a longevity bet. That framing is not wrong, but it is profoundly incomplete because it ignores the tax cost of early claiming during the conversion window. Here is the actual mechanism. Social Security income. Up to 85% of it, depending on your total income, is taxable as ordinary income. When Dave starts collecting Social Security, that income occupies space in his tax brackets, space that was previously available for Roth conversions. The Social Security check and the Roth conversion are competing for the same room. Let's say Dave claims at 62, his benefit, reduced for early claiming, might be around $23,000 per year. 85% of that roughly $20,000 is taxable. That $20,000 fills up bracket space that could have gone toward converting traditional IRA dollars. Every year from 62 to 75, 13 years, he has 20,000 fewer dollars of conversion capacity per year. Multiply that across 13 years, and you have $260,000 less converted at the lower rate. Some of that money stays in the IRA, compounds, and eventually gets forced out via RMD at a higher rate. The early claiming decision doesn't cost you just the benefit difference. It costs you a piece of your conversion strategy. Now flip it. Dave waits until 70. His benefit has grown by roughly 77% compared to age 62, 8% per year of delayed retirement credits from age 67 to 70. He starts collecting $43,000 a year instead of $23,000 more lifetime income. And for the entire period from 60 to 70, his brackets are clear. No Social Security income crowding out conversion space. 10 years of maximum conversion capacity. When Social Security starts at 70, the RMD clock is only 5 years away. By that point, if Dave and Linda have been converting aggressively, the IRA balance is significantly smaller. The RMD and the Social Security income stack on top of each other, but the RMD is much more manageable because the balance driving it has been reduced. Social Security timing is not a longevity question. It is a tax planning question. The monthly benefit is visible. The bracket crowding is invisible. And invisible costs are the ones that compound silently for 15 years before you notice them. There's something else building in the background of all this planning that I want to address now, because it weaves through the rest of this video in a way that matters. Almost every couple building a retirement plan imagines the two of them moving through it together. Same tax bracket, same filing status, same income picture. But one of them is going to outlive the other. That is not pessimism. That is actuarial math. And the year the surviving spouse files their first solo tax return, the rules change in a way that can be devastating if the Roth conversions weren't done. Every dollar that Dave and Linda convert during this window is not just about optimizing their joint retirement. It is insurance for whichever one of them faces retirement alone. Keep that in mind as we get into the next part. Now, the IRMAA Landmine. Stay with me, because this is where precise execution matters more than general strategy. IRMAA stands for Income-Related Monthly Adjustment Amount. In plain language, it means that Medicare charges higher income retirees more for the exact same coverage. Not better coverage, not faster service, the same plan, just a larger premium. It functions like a tax bracket, except worse, because when you cross the threshold, the surcharge doesn't phase in gradually. It hits all at once, like stepping off a curb you didn't see. For a married couple in 2026, the first IRMAA threshold sits at approximately $220,000 in modified adjusted gross income. Cross that line even by $1, and Medicare Part B and Part D premiums for both spouses jump by roughly $2,300 per year combined. $1 of excess income, $2,300 in additional premiums. That is not a bracket. That is a cliff. And here is the compounding problem. IRMAA uses a 2-year look back. Your Medicare premiums in 2028 are based on your 2026 tax return. So the Roth conversion you run this year is quietly setting your healthcare costs 2 years from now. If you are running large conversions without accounting for IRMAA, you may be saving money on future taxes while accidentally spending money on future premiums. You are optimizing one number while inadvertently detonating another. For Dave and Linda, this creates a very specific guardrail. Before age 63, IRMAA doesn't apply, Medicare hasn't started, and the 2-year look back doesn't reach far enough back to matter. In those early years, they convert as aggressively as their brackets allow. After 63, they switch to surgical precision. They model their total modified adjusted gross income conversions plus dividends plus any other income and stay just below $220,000. Not $222, not $221. They target $219. That is the difference between a controlled strategy and an accidental $2,000 surcharge that repeats every year for the rest of their retirement. Someone once told me they converted $215,000 that year. Felt great about it, then found out that their dividend income pushed them to $224,000 total. The IRMAA surcharge hit for the next 2 years before they caught it. $7,000 of unnecessary Medicare premiums. Because nobody added the dividend income to the conversion income before finalizing the number. The math has to be complete, not approximate. Complete. There is a second hidden landmine I promised earlier, and it is the one I find most emotionally heavy to talk about, because it lands at the worst possible moment. When one spouse passes away, The survivor transitions from filing jointly to filing as a single individual, starting the tax year after the year of death. That change in filing status cuts the available tax bracket space nearly in half. The 32% federal bracket for married filing jointly doesn't kick in until roughly $400,000 in 2026. For a single filer, the same bracket starts around $245,000. The standard deduction, including the additional deduction for taxpayers over 65, drops from around $31,000 for a couple to around $15,000 for a single person. The RMDs don't get smaller. The IRA doesn't shrink because there's one person instead of two. The distribution schedule is based on the account balance, and the survivor's first full year of single filing arrives at the same time they are grieving, managing an estate, and reorganizing their entire financial life. The silent partner does not acknowledge any of this. Every Roth dollar Dave and Linda have built is immune to this problem. A Roth IRA passes directly to the surviving spouse and is treated as their own account. No RMDs, no forced distributions, no taxable income created automatically. The Roth is the one asset that does not get more complicated when the household changes from two people to one. You cannot fire the silent partner, but you can buy them out now so your spouse does not have to deal with them alone later. Let me bring all of this together with the actual numbers, because the system only becomes real when you see the outcomes side by side. Dave and Linda executed the buyout plan. They converted aggressively from 60 to 63, roughly $160,000 per year at the 22% rate. From 63 to 70, they converted up to, but never past, the IRMAA threshold of $220,000 in modified adjusted gross income. They waited until 70 to claim Social Security, keeping their brackets clean during the peak conversion years. They lived off the taxable brokerage account during the conversion period, minimizing the income competition. And they did the survivor planning, building a large Roth balance, specifically to protect whoever ends up navigating retirement without the other. At age 75, their traditional IRA balance is approximately $1.2 million. Not $4 million, $160,000, $1.2 million. Their first RMD, calculated on that reduced balance at the age 75 divisor of 24.6, is roughly $49,000. Compare that to the do-nothing RMD of $169,000. They are pulling out $120,000 fewer dollars of forced taxable income every single year. Their combined Social Security, both benefits claimed at 70, brings in approximately $65,000 annually. Total income from RMDs and Social Security, $114,000. They are solidly inside the 22% bracket. Comfortable, predictable. They set up monthly RMD distributions with automatic tax withholding. So there is no April scramble, no quarterly estimated payments, no underpayment penalties. The Roth IRA holds approximately $1.4 million. It compounds tax-free indefinitely. They can draw from it whenever they want at zero tax cost without it touching their IRMAA calculation. If they want to give money to charity, they run a qualified charitable distribution directly from the traditional IRA. Money goes straight from the IRA to the charity, never landing on a tax return, never counted as income, never triggering IRMAA. The IRS allows up to $105,000 per year in qualified charitable distributions for 2026. It is one of the few places in the tax code where generosity and efficiency is point in exactly the same direction. The difference in total federal taxes paid over a 25-year retirement between this optimized plan and the do-nothing scenario for a couple at this asset level has been analyzed by researchers at institutions like the American College of Financial Services to be in the range of $150,000 to $300,000. $300,000. Not returned by higher returns, not generated by taking more risk, just kept by understanding the rules and executing the plan before the window closed. Here is the 4-step framework, the buyout plan, in the order you should actually do it. Step 1 is to know your projected RMD before you're 60. Find the IRS Uniform Lifetime Table online. take your current IRA balance, assume 4 to 5% annual growth for conservatism, and calculate what the balance looks like at 75. Divide that number by 24.6. If it is larger than what you expect to need to live on, you have a structural problem, and you have time to solve it. Step 2 is to map your bracket space from today to 75. Look at each year, what income do you expect? What brackets are open? How much room is available for Roth conversions before crossing from 22% to 24%? This part requires a multi-year tax projection, which sounds more complicated than it is once you have the income inputs identified. The calculator in the description does a version of this automatically. Step 3 is to coordinate Social Security timing with the conversion schedule. Run both scenarios, claiming at 62 and claiming at 70, and look at the effect on your conversion capacity, not just the monthly benefit difference. The bracket crowding caused by early Social Security is real, it compounds annually, and it is almost never included in the standard claiming analysis. Step 4 is to install IRMAA guardrails starting at age 63. Know the threshold. Model your total modified adjusted gross income, every source of income, not only the conversion amount. Stay below the cliff. And revisit the threshold every year because it adjusts upward with inflation. That is the entire system. 4 steps, 15 years, structured correctly. This is not complicated. The tax code is dense but not random. Every rule has a structure, and the structure, if you read it carefully, disproportionately benefits people who plan early. We open with the silent business partner. That partner is real. The stake they hold in your traditional IRA is real. The forced withdrawal schedule they control at age 75 is real. The good news is that nothing in the tax code says you have to wait for them to call the meeting. You can do this on your own schedule, in your own bracket, at a rate you choose. You can shrink their ownership stake to 0-1 Roth conversion at a time before they ever get the chance to set your income level for you. Here are 3 things to do this week, not eventually. This week, first, run your projected RMD. Go to the IRS website, open the Uniform Lifetime Table. Take your current IRA balance, grow it by 5% per year to age 75, then divide by 24.6. That number is your baseline. If it exceeds your expected living expenses, you are looking at the gap the buyout plan closes. Second, identify your empty bracket space right now. If your taxable income this year is lower than usual early retirement, a gap year, a year between jobs, any year where your income has dropped, you have conversion room sitting unused. A specific dollar amount, calculate it. Converting even a portion of it at the 22% rate instead of the future 32% rate is a measurable, permanent gain. Third, before you make any Social Security claiming decision, model the tax impact on your conversion capacity. Not just the monthly benefit, not just the break-even age, the full picture. What does this income do to my bracket space for the next 5, 8, 10 years? That analysis will likely change the answer you were expecting. Lazy investing built more fortune than crypto memes, and the silent partner is counting on you not to believe that.